Well, let's get across the market open now. James Garish joining us from Market Matters. James, good morning to you. Bit of a lower session we saw on Wall Street overnight, obviously weighed down by what we're hearing out of the Middle East, the Strait of Hormuz remaining solidly closed at this point, but also very much a focus on inflation with those numbers due to drop tonight our time.
Yeah, the saga continues, Andrew. So we're continuing to have these ebbs and flows of what's playing out in the Middle East. We, pretty much don't know where we stand on it. There's, the rhetoric coming from the US is more positive than the rhetoric coming from the Iranian side. So for now, we need to wait and see. I think the market's probably become a little bit more desensitized to it. So oil prices were up last night, not materially so, but they were up last night. But we had bond yields lower in the US, equities a little bit lower in the US. And of course, as you may mention, we've got this key CPI data out tonight. So obviously inflation is going to be key, but we have the period that it's measuring. We did have lower oil prices, so energy prices. So I wouldn't expect that to be a strong number in the US tonight. So hopefully we get a bit of resolution out of there, and hopefully get some clarity around the inflation picture, and hopefully the market continue to key off earnings, which have been really strong.
Well, speaking of which, let's turn to the local market. James, what are you making of the momentum we're seeing there at the moment? Obviously, recently taking out a new record as reporting season gets going.
Yeah, I mean, the rally's been driven largely by the mining sector, which is, if you think about the earnings they're going to deliver, they're at the EPS level, the ASX is supposedly, according to consensus, going to increase EPS by 12% for the year. The lion's share of that is being driven by the mining sector. So mining stocks have been doing well. Commodity prices have held up. One of the key areas in copper has been really strong, even though we've had this instability over in the Middle East that could really have derailed the concept of global growth. So, and that's really critical in the copper space. So copper to me continues to look good. That's driving a good rally in the mining stocks. Gold has found form again and is rallying. So miners have underpinned this move in the ASX for now. We've got CBA out with results this morning, which is going to go a long way in terms of the sentiment towards the banks, I would imagine.
All right, well, let's go there then, James. What did you make of those numbers? We've got some CBA.
Yeah, so cash earnings of 10.98 billion for FY26. That was up 7.1% on FY25. So that was a strong result. It's about a 1% beat in terms of consensus. Consensus was at 10.85 billion. Net interest margin was in line with expectations at 2.05%. Their cash ROE, return on equity, was strong at 14%. That was a shade above, about 10 bips above where the market was expecting that to be. Final dividend is also higher as well at $2.70 versus $2.60 this time last year. So I thought this was a pretty good update from CBA. The other important trend was that the second half continued to improve. They had quite a strong second half. And then in terms of loan applications, they've actually said that things have stabilised in the last couple of weeks. So that goes against some of the more bearish commentary we've seen from Westpac and NAB earlier in the week when they delivered trading updates, Andrew.
Yeah, well, why do you think that is the case then, where they're a little more positive? And James, I mean, what are the expectations just in terms of intense competition in the mortgage space?
Yeah, well, I think it's pretty clear. So CBA has been going harder in the space. Westpac hasn't reduced prices as much as some of the other banks, so they're feeling the volume pressure a little bit more than the others. So, I've only seen the headlines on CBA. We'll have the analyst call with CBA later on, so we'll get more granular detail in what they mean by that and the trends around that. But clearly, I mean, they're talking about a very short-term window. They're saying in the last couple of weeks it's stabilised. So, their application volumes were strong. They've come off the boil, and they're saying that they've tentatively found a base in the last couple of weeks. So we'll need more detail. We'll meet on the bones around that commentary, Andrew.
James, let's turn to the insurers with a focus on Suncorp, and it's reported a 28% fall in its full-year cash earnings.
Yeah, you'll get some juicy headlines out of that declining cash earnings, but you've had a couple of big catastrophes that have weighed into that, so that the cost of those catastrophes came above their cap. So they've made moves later in the period to address those things. So by upspecing their reinsurance program, so that's a positive for Suncorp. I thought the result today was fine. So cash earnings at 1.04 billion, shade ahead of the 1.0 billion that we had in terms of consensus. They've also announced a 10-cent special dividend on top of the 52-cent final dividend. So in the first half, they did 17 cents because of that big earnings impact from those catastrophes. They've made up for it in the second half. So the market was expecting 68 cents for the full year. So it's about 11 cents, I should say, ahead of full year market expectations. They're going to continue with a buyback as well, $250 million of additional buybacks in FY27. So I thought it was a solid update from Suncorp, despite what the headline decline in earnings would imply, Andrew.
And AGL, James, the gentailer, it's reported a close to 2% fall in annual underlying profit. What's your interpretation?
Yeah, this is an interesting one. Two components to it. So obviously, like in any result, so the actual result in FY26 and then the guidance for FY27. So it's about a 1.5% miss to consensus at both the revenue and NPAT line for FY26, so slightly below expectations. I think guidance is probably the more interesting or important thing for AGL. So FY27 was always going to be a bit of a soggier year for AGL, so that was broadly expected by the market. They've guided to revenue, they've guided to NPAT of 470 to 670. To give you a guide there, so the midpoint there is 570. The market's currently at 535 million. So if you take the midpoint, but you can drive a truck through that guidance, right? You've got a $200 million gap between the low end and high end of that guidance range. So they typically narrow that as the year progresses, but it looks positive in terms of where the midpoint of that guidance would be relative to consensus. But if I look at EBITDA, I mean, they're saying somewhere between 1.9 and 2.2 billion. So 205 at the midpoint, which is about where markets are at the moment. So slight miss in FY26. Choose your own adventure on their guidance in FY27. There's a big variance in their range of expected outcomes, Andrew. But it's okay. It's an okay result.